All right. Welcome, everyone. Welcome to Creating Your Future. And my name is Wes Paterson. I'm a certified management consultant, and I'm so happy that you took some time out of your busy evening. I know life's busy, people have kids, they're off to all kinds of things. Myself, we have family heading out to Vegas in a day or so, and yeah, so thank you for making time to invest in yourself and look at finances and what you can do perhaps a little bit differently coming here into 2025. So I'm just going to pull up my slideshow here. And so this webinar today is called Create Your Future. It is geared towards Canadian tax strategies, but there's going to be information within this webinar that are applicable whether you're in Canada, the United States, or essentially anyone, anywhere in the world. So there's going to be a lot of value in the webinar today. So my name again, Wesley Paterson. I'm a trusted advisor and a certified management consultant. I have a proven track record of helping clients achieve their financial, business, and organizational goals. One of our accomplishments last year is um, we received National Champion in Canada for CMC Canada, and we're an International Constantinus nominee. We made it into the top six consulting projects in the world. So we're pretty proud of that. I was also received the Emerging Professional of the Year through IMCA. So a couple big wins on the award front last year. I'm committed to providing personalized financial and business advice and helping clients make informed decisions about their financial future. Now, as we go forward, I just want to put forward a disclaimer. This presentation is for entertainment purposes only and focuses on general information. Everyone's situation is unique, thus seeking a trusted professional, such as myself, for quality advice is highly recommended. Okay, so that's my disclaimer coming forward. These are my ideas, my opinions, and therefore general entertainment purposes. But I'll provide some information at the end where and how you can connect with me, and we can look at how we can apply what's been delivered here to your unique situation. So one of the things we want to look at first when we're getting on the path of wealth and getting on the path to financial independence is we want to start setting some goals. And so if you've already blown through those New Year's resolutions, now might be a good time to start setting some money goals for yourself, clearly defining what your financial goals are and starting to craft and create a plan to achieve them. You might have some short-term goals. You might have a trip coming up. You might be wanting to do some renovations to your house, and you might have more lofty goals. Maybe you're going to buy a vacation property. Maybe you're hoping to retire in the next 5, 10 years. So again, it's important that we set those goals with the end in mind, and then we can start reverse engineering and chart a clear path to attainment. And then we want to look at investing. We want to not only look at just investing in the highlight stock of the week, but we want to be very diversified. We want to look at a diversified portfolio so that we can reduce our risk while maximizing our returns. And then we also want to look at saving and being consistent. So developing a consistent savings plan and tracking your progress regularly. The more you can start automating these systems, set and forget it, the easier it'll be to accomplish your goals in investing and savings. One of the things I always tell people is you want to pay yourself first. How does debt feel? To me, when I hear the word debt, debt feels really heavy. I think we should eliminate the word debt. If we keep focusing on debt, we're going to bring in more debt. Think of debt as previous expenditures that you had. And ultimately, who is number one? You should be putting yourself number one. So you need to prioritize your savings. You want to invest wisely and start to build wealth. One of the great books is The Richest Man in Babylon. And The Richest Man in Babylon focuses on living off 70 to 90% of your income. Now, for some of you, you might be thinking, how on earth am I going to do that? Rising expenses, fees. Well, perhaps you need to expand and start looking at other ways that you can bring income in. And part of that is by reducing your tax exposure. So that's why many of you are here tonight, to learn some ideas and strategies to do just that. So why should you consider taking advantage of Canadian tax investment strategies? Well, number one, you're going to reduce your tax liability. You're going to maximize tax savings and keep more of your hard-earned money. Now, for 2024, the window of opportunity to take advantage of some of these is narrowing very quick. We're entering the final month where you'll be able to take advantage of RRSPs if you're here in Canada, your Registered Retirement Savings Plan. And for many of you, this is a great way to immediately get a 30% or higher return on your money. Meanwhile, setting and forgetting your money. And then we're also going to look at where you're putting that money and what you're going to do with that. Because then that's going to focus on then growing your wealth, investing your money wisely, and beginning to watch it grow over time. Not watching it every single day. You'll become neurotic, and then you'll have a tendency to try and time the market. You'll be running on emotions, and that's usually a recipe for disaster. So you want to set your plan, set it and forget it, get your wealth growing, and then keep that plan for the future, whatever that entails, retirement, education, and other life goals. So I'm going to run through a little example here because many people are like, well, what do I do? Do I get control of my debt or do I start looking at my investments? And so I'm going to run through a scenario example of this might be a strategy that you deploy to essentially do both. And note on this slide, these numbers are pre-COVID. So I estimate that the interest on both of these have rose significantly. For example, this is based on an 18% credit card debt. And we already know 8,600 for the family. This has gone far higher. I'm not sure if it's double yet, but it's significantly higher than 8,600 at present. And so based on an 18% credit rate, if you're going to pay this down within a decade, you'd be looking at payments of $430 per month just to pay down that $8,600 credit card debt. Now, the average Canadian family also typically pays about just shy of $40,000 in taxes annually. Many families are going to get hit this year, and as I'm recording this, it's January 2025, with a hiked up capital gains tax. Now, whether you think that's right or wrong, there's probably going to be some lawsuits coming forward. At the end of the day, my recommendation is that you pay those taxes if you are being hit with that capital gains tax. And if the lawsuits are successful, then chances are you're going to get your income back. But you don't want to be in the CRA's bad books. Now, one of the strategies that many people are unaware of is that you can do RRSP loans beyond 1 year. Some people often go to their local bank and they'll have 1 year or sometimes even a 2 year options, but you can actually stretch out an RRSP loan for a decade. And so based on this RRSP loan, again, these rates are probably a little bit on the low end, both on the credit card and at 18%. And on the RRSP loan, I believe that this was around 7 to 7.5%. But based on this, you'd be paying $360 a month over the course of a decade for a $30,000 RRSP loan. And you might be thinking, why am I going to take out a loan for an RRSP? Well, bear with me because there's a method to the madness here. What that's going to do is that's immediately going to have $30,000. And if you're in a 30% tax bracket, which if you're paying $39,000 in taxes, you likely are, you're going to increase your tax return by approximately $9,000, possibly more. So what are you going to do with that $9,000? Well, in this scenario, you could take that $9,000 and you can put it right on that credit card. So now you can pay off that debt. Now, what you've done here essentially is you've reduced that monthly payment from $430 to $360. You also have an extra $400 cash in your pocket, and we're going to go over what the savings are over time, but you also have $30,000 growing in capital markets, and we're going to run through what that potentially can look like in that same decade where you would have just been paying off your credit card anyway. And so you're going to pay off the credit cards, but you're going to also lower your monthly payment. So I'm just going to stop sharing this screen for a second. And I'm going to jump in to another screen example. So just bear with me. I'll get my window up. So what you're going to see is you're going to see my Google window open, and any of you watching this, you can type into your Google bar Ontario Securities Commission compound interest calculator. Now there's many compound interest calculator tools on the market. I just happen to like this one. I find this to be very practical. So I click there on the link, get smart about money, and we can look here. So if we look at the compound interest calculator, and we're just going to scroll here, we're going to look at what the initial investment is, and we can play around with different interest rates. So let's look at that $30,000 that we now have from that RRSP loan. And what I usually conservative based on the investments that I put people into, which are diversified mutual funds in the global economy, we usually can say conservatively that we can average a return between 9 to 12%. So if we look at 9%, we're making no further additions, compound interest, and we're going to run this for a point of 10 years. So now that money that's sitting in there, in that RRSP, so what we're going to see is that over the course of 10 years, that's going to grow to $73,000, and the interest earned is $43,000 if it does 9%. But I said between 9 to 12. So if we look at 12 and we run that same calculation, well, now we can see that jumps to 99 with 69,000. So just based on this conservative example, over the course of the decade, we could build wealth for retirement between $73,000 to $99,000, which we wouldn't have had otherwise because we would have been paying that credit card debt. Now, another thing to factor in is we're also saving money each month. So that money that's being saved each month, that was I believe $70. It was $430 to $320. So let's say we started here and we thought, maybe I'm just going to put that money into a TFSA. And we're going to do regular additions monthly. So, hey, I'm saving that money. I would have been paying it anyway to pay off that credit card. So let's do $70. We're starting with zero. Well, maybe we'll start with our initial payment. We start initial investment of 70 and we're doing regular additions. Again, let's use the example 9% and let's run that for 10 years. We've put that into a TFSA. Well, now, not only have we built retirement, but we've also built a tax-free savings account. If we only do 9, we're going to have about $13,000 in that. If we do 12, well, now we see that jumps closer to 16. So think about 13 to 16. If we just reinvested that money that we would have been using to pay down that credit card payment anyway over the course of a decade, that's $70. Plus, we have that that RSP loan. We're making the payment on the loan and we're building wealth in capital markets. Okay. So jumping back to the slide here, it's important that we look at where we're putting our money. RRSPs, TFSAs. And often people get confused about this and they think that these are bank products. They're not. Think of an RSP as a container and think of a TFSA as a container. And they both have slightly different purposes. So what an RRSP does is it allows you to defer paying tax so that you can build up a plan for retirement. Whereas a TFSA is money that you put in after tax, and then any of the money that you build, that you grow through your investment, when you pull that out at the end, it comes out tax-free. So if I'm talking with a couple, a husband and a wife, what I'll usually say is we want to try and set up number one, an RSP for the man, an RSP for the woman, a TFSA for the man, a TFSA for the woman. And we want to try and balance these accounts. And there's a method to the madness because when you start pulling out money at retirement, if you've only built up one individual's RRSP, you're going to get hit harder tax time. Let's say you have very minimal expenses at retirement and you're going to pull out, for example, $40,000 out of a single RRSP. Well, you're not going to pay tax on that first 20, but you're going to pay tax on the second 20. Whereas if both individuals have an RRSP, well, then you can pull out 20 out of each, and then you can pull out any additional remainder out of your TFSA, and you're not going to pay any tax at retirement. And so that's the strategy that we want to move people towards so that even in retirement, you're minimizing your tax exposure. And so other saving strategies that we can look at deductions, okay? Make sure you identify and utilize all eligible tax deductions to minimize your tax liability. I recommend getting a good accountant. Some people think, well, I pay a little bit more. Is there beneficial? If you have a good accountant, it's going to be worth what you're paying your accountant for the deductions that they'll be able to help you with. You can also start planning tax planning. So plan your financial decisions strategically to optimize your unique tax situation. If there's someone with a disability, make sure that you apply for the Canada Disability Benefit. Again, it's a no-brainer. Not only can you benefit on that end, but below a certain age, anyone under the age for sure of 40, you're going to be able to set up a registered disability savings plan. And based on income thresholds, some people are getting 300% matching contributions. So a great program for anyone with a disability. Other credits, you want to take advantage of available tax credits to further reduce your tax burden. Now, I'm going to talk a little bit about insurance. I'm not going to dive too deep into it, but it's amazing how many people I talk to that have whole or universal life insurance policies. And I think they're making a grave mistake by having whole and universal life insurance policies. Sometimes they're sold on, well, I'm it has a savings component or it has a cash value component. But what people don't realize is that with some of these policies, if you pull the cash value, then you've eliminated the policy. So you can't do both. Universal is a little bit different, but when we run the numbers, unless you're in certain situations, it's almost always, with most people that I meet, better to look at buying term and investing the difference. And I'm going to talk a little bit more about this because properly setting up a term policy and investing the difference is a method to set yourself up where you become self-insured. So you no longer require that insurance policy and you can just keep building your nest egg. So definitely anyone in their 20s, 30s, even early 40s, you definitely want to look at term policies and investing the difference. And then you want to combine this to add that financial security to meet your needs. And then you can also add different things. People often in the insurance industry don't like me talking about this, and there's good reason because commissions are often far higher to agents who sell whole life or universal life policies. So commissions aren't high on term insurance policies. And I think this is where we sometimes have a conflict of interest because sometimes we have people not necessarily doing what's best for the client because there's a selfish motivation. Retirement planning, one of the best things you can do when looking at retirement is start early. The earlier you start saving, the more time your money has to grow, and the less time you have to worry as it comes to retirement. You can make smaller, regular contributions, and that over time, that can compound and grow to a significant nest egg for retirement. You also want to diversify investments. You want to spread your investments across different asset classes to manage risk. And you also want to spread your assets and funds across different countries to manage country exposure or country risk. You want to be diversified in the global economy so that when one fund is going up, the other might be going down and vice versa. But they're always going on that upward path the majority of the time. And then you want to regularly review and adjust depending on your age and stage in life. There are great ways we can look at maximizing retirement planning. I've helped couples in their 70s and their 80s that we looked at their financial situation and there's the potential of them running out of money in the next decade. And we've been able to turn that around and actually build significant growth in their portfolios because they just were set up in the wrong funds and we could still minimize the downside risk. Estate planning. Do you have a will? Do you have a will, which is a legal document that outlines your wishes for your assets after your death? If you don't have a plan, the government does. Okay, so you don't want you want to take estate planning in seriously. You want to look at this. Power of attorney, you're going to want to appoint someone to manage your affairs in the event you become incapacitated. And this can another thing that we want to look at sometimes when we're looking at wills, power of attorney, is medical directives. What are your wishes if you become ill, you become sick, and you're no longer cognitively there to make decisions. And then you also want to set up the beneficiary designations to designate who will receive your assets from retirement accounts and other investments. Sometimes people avoid looking at wills, power of attorney because of higher legal costs. There's also ways we can work around that. There are some programs that we can work with clients that can actually significantly reduce your legal costs to get a will done, to get medical directives, and set this up. So, again, at the end of this presentation, I'll be sharing some contact information. You're welcome to reach out, and I can provide you more information on estate planning. Why becoming a landlord might be worth considering as a strategy to build equity, wealth, and diversify your portfolio. Well, I reside here in the city of Medicine Hat, and we are extremely grateful that we took the plunge into becoming landlords several years back. And we started with one property, which led to another property, which has led to a third property. Now, when we look at the market, there is nothing available. There is literally, it is a seller's dream market because there's nothing available here in the city of Medicine Hat. There's also very low vacancy rate. So one of the things is we can have very good tenants and we have excellent tenants in our properties that are there. Now, what I highly recommend, again, you can manage the properties yourself, taking all of that, but I would highly recommend setting up if you're looking at becoming a landlord, looking at, especially if you're going to have multiple properties, looking at getting a good property manager. They just take so many of the headaches away. Literally, they manage the tenants, they manage if there's any issues, and I gladly pay the 8-9% because I built that in to what that property is generating from rents. And it's a great way to build passive income, but to also build equity. And that equity can then be utilized for other purposes. You can utilize that equity to buy future properties. You could utilize that equity for travel, for renovations. You could utilize that equity for other investments as well. So there's lots of value to consider getting into the real estate game as well and becoming a landlord. Charitable giving, tax deductions. Make sure that if you give to and support to charitable organizations that you receive receipts because you often can claim that up to a certain percent value on your income taxes. So you want to make sure you do that. It also gives you that great feel good. You become a great community player, you make a difference, and you get to support causes that you care about and make a positive impact. Another thing to consider is whether you have kids or not, you might want to include charitable giving in your estate plan so that you can leave a lasting legacy. One of the recent announcements here in the city of Medicine Hat was the Ewell Foundation giving $5 million towards health and wellness programs at our local college. And that's just going to provide so much value over the years to our community that, I encourage you to consider charitable giving. I find anytime I give, it comes back in spades. Homeowners, if you're renting right now, you might be looking eventually at becoming a homeowner. And that first example I showed, let's say you're a couple years out of school, you might be thinking, how am I ever going to afford a home? How am I going to save for that down payment? Well, one of the things you could do, because especially if you don't have that high credit card debt that you want to clear off at 18, 22, 28% interest, is you could use that exact same strategy and take advantage of the Canadian first time home buyers plan. So you could use that RRSP loan. It has to sit for a period of 3 months. But in that example I showed above with a $30,000 RRSP loan, you put it in, you then can pull that 30,000 out. You have to repay that over the course of approximately 20 years at certain contribution amounts. But then you're also going to trigger that tax return of 9,000. So now you have almost $40,000 to put towards your down payment. Um, Other things you can look at if you become a homeowner is you can look at mortgage interest. We can start deducting that. We want to make sure we deduct that. We want to make sure we deduct property taxes and any home renovations. So any expenses, home renos. Again, we're putting value back into that, but we want to look at all those deductions that we can make come tax time. Investing in yourself, investing in your children through education. Again, these are other things that we can take advantage of tax deductions and tax credits. So tuition, you want to make sure you claim your tax credit for tuition fees paid. Textbooks, you want to deduct the cost of textbooks and other educational needs, laptops, maybe you're purchasing a bus pass, whatever that looks like. You want to make sure that you keep track, keep receipts of all of those expenses that go towards education. Every year, I'm utilizing write-offs towards education. Often that's through my business as part of ongoing training and development, but it's something that I can't stress enough is cultivate a mindset of becoming a lifelong learner. And just like you're attending this session here today, invest in your education, whatever that looks like for you. There's also a number of tax benefits for small business owners. These can range from things like home office deduction, business expenses, and such. So I definitely recommend if there's something you've thought about and you thought, maybe I could do a part-time job, or maybe there's something of interest, I would encourage you to look at getting a home-based business license and setting up now you're in business. Immediately, you now can take advantage of these business write-offs. You can take advantage of business expenses. You can write off part of your utilities. You can write off your phone bill. You can write off internet expenses. So there's a lot of benefits to consider starting a home-based business. In addition, you can start generating additional income streams and passive income. And again, you can then put that back into investments, rental properties, other passive ventures, and those can also further lower your tax liability. Maximize your returns. Now, when we're looking at investments, we always want to make sure that we're looking at maximizing our returns. So one of the things we might look at is strategic fund transfer. We want to move money from underperforming pensions and group RRSP plans to better performing funds that can significantly improve your return. It's amazing how many people have worked for a company, they previously had a group RRSP, or they had a pension, or they had some sort of investment, and they don't do anything with it because they, A, haven't really paid attention, or B, don't realize they can. And if you've joined tonight, I want you to really pay attention if you have any of these funds to dig out your paperwork, get your documentation, and see how is my money performing in these funds? Because there's a good chance that we can strategically move that money into better performing funds and have that grow and set you up for success. I'm going to run through a few other examples here shortly on what that potentially could look like. You also want to take control by actively starting to be involved in managing your investments. You can unlock greater potential for growth and reach your financial goals. So when I really started getting serious a little over a decade ago with my investments, I became actively involved with them. I was sitting down with my advisor at the time. I was educating myself through books, through classes, through courses. Um, I took some financial courses, but I also had a business education. So I was really involved in taking control. So even though I wasn't licensed at that point in time when I first started, I was always taking control and heavily involved. And I take that approach with my clients, every client I work with. I want them to learn, I want them to become involved. And ultimately, if they want to get licensed, that's an option for them. They can get licensed and then they can start taking control. And then they might look at that maybe down the road as a passive way to develop further income streams by managing funds for themselves and friends and family. And then you also want to have expert guidance. It's great to have a trusted advisor that can help assess your portfolio and recommend optimal investment strategies for your situation. One of the things that I love now that I am an advisor is I have access to people right in downtown Toronto. I can call individuals, they can walk down the hall, they can chat with the fund managers. So it's just furthering my wealth creation the more education I have, and especially now that I am certified and I have the ability to advise others. So it's really growing wealth in all these areas. So just before I jump into the conclusion, I'm going to just reshare this screen here. Okay, so we're going to jump back up to our compound interest calculator. And I'm going to use a couple examples. So one example I'm going to use is one that hits home here. So this is my wife, and she's given me permission to use herself as an example. So initially, when she left her one position, she had an initial investment of approximately 150, 151 in a pension. And pensions are great while you're working at an organization because often you're putting money in, and if it's a matching pension, your employer's matching it. So while you're working at the organization, you want to take advantage of that. Now, one of the rules here in Canada with pensions is the magic number is 54. So after the age of 54, you can't move money or do the strategy I'm going to show you here. So there is a time permitted, but if you leave a position prior to age 54, this is a strategy that you can look at doing and perhaps retiring as much as a decade sooner. So I run this with some people, and when we go through it, we see that, hey, they could retire at age 55 rather than staying at a company. Sometimes people feel like they're just burning time to get that pension, and they're staying right till 65. And one of the unfortunate things that happens is lots of times people will stay at these jobs, get the pension, and I've heard of a number of people that after retirement within 1 to 3 years they've passed away. Maybe they've lost that purpose, from what that job was bringing. So no matter what, you want to make sure that you're finding purpose, value in your life. But using, again, jumping back to my wife's example here, I was able to, through a certain method, I was really good at math. I was able to come up with the rate of return that her pension was delivering. And again, I won't talk about which company she worked for on this webinar, but again, contact information, and I'm happy to share more about that one-on-one. And so we're looking at that, and 20 years to growth, and we calculate that. So we're looking at the amount that was in her investment, 20 years to grow to about age 65 would put her at, the value of her pension was going to be about 193,000. So she moved it not even 2 years back, and we did a little bit better. So again, I tell people conservatively 9 to 12, since after fees, net fees just under 17%. So we're going to call it 16% here. And 16% this year and a half is, you saw there growing to 193. Well, that current pension that she had is now sitting at 198. And so I'm just going to show you here. So it's 198. Now it was 16. Now, mind you, let's knock off 2 years there. So we have maybe, let's say, 18 years to grow. It's at 198 right now, but it's not growing at that low percentage. So what I'm going to drop this down. Let's say it goes back and it goes to my conservative 9 to 12. So I'm just going to run the calculation for you. So if it only does 9, we can see the difference of this. It's already surpassed what it would have been if she would have just kept it where it was at. But it's going to go fivefold if she just does 9 in the next 18 years. What if she does 12? Let's run that scenario. Well, she does 12. Nelson jumps to 1.7 million. Again, so 1 to 1.7 million in the next 18 years, conservative. I don't think it's likely going to do 16 consistently year over year, but let's say we do 15. Let's just run that hypothetical. If it continues how it's been running already, that's going to be closer to $2.9 million. So again, less than 2 years, already surpassed the amount. And this is just the power of taking control of your investment, taking control of your money. Often people have money in TFSAs. So I'm going to use an example of, let's say you have $10,000 in a TFSA. You have $10,000 in a TFSA, and I've actually met with people and they've had TFSAs that are doing about 3%. We're going to just change this to 20 years. So you got that TFSA, it's doing 3%. Let's run that for 20 years. So after 20 years, 3%, that TFSA of $10,000 is going to grow to about $18,000. And I'm not going to say who this is, but again, another client example. Well, the client had RRSP room, and they already had a TFSA. So what we did was we pulled the money out of the TFSA to their checking account, and then we put that money in to an RRSP. They are at a 30% or higher tax bracket, so they got a little better than $3,000 back on that. Now he put them into investments, and they're doing higher than this. I'm not going to say what they're doing, but they're doing higher than conservative as well. But let's run this example. Now, This is an RSP, so it's a little bit different. So that's going to run for that same 20 years, but let's say that runs at 9%. Well, now that RSP is going to grow to 60, but you might be saying, well, Wes, but when they pull that out, they're going to have to pay that tax. But in the meantime, they've leveraged the money to build a bunch of interest. So they're paying tax. Primarily, the tax payment is going to come, if any, from the interest they've made compounding that. But let's look at what they did was they took that tax return money and they put that back into a TFSA. So now let's say that $3,000 just continues at that 9% for the 20 years. Well, isn't that interesting? That $3,000, do you remember the 10,000 at 3%? If it does, it's going to do 18. Well, this $3,000 is going to do 18 in that same period of time. Now, remember, this is the low end. So let's say they do 12. Well, now they're going to do just on that $3,000 TFSA in that same period of time, 18 to 32. Let's jump back now. If that RSP does 12. Well, now that RSP potentially could do 108. So we can see there's jumping between that 60 plus to 108 plus that 18 to 32. So you can see significant wealth, and all we did was we looked at moving money around. So I fed you a ton of examples here. There's plenty more that we can go over, but some of the key takeaways that I want to leave you with here as a conclusion is you want to plan ahead. For 2024, you've got about a month if you want to make some moves, but plan ahead regardless. Take advantage of tax strategies to maximize your savings, achieve your financial goals. Maybe you want to just start revisiting what your current investments are. How are those performing? Am I getting 9 to 12 on my investments right now? If not, look at the next one. Seek professional advice. Consult with a trusted advisor, aka Wes, to understand your specific situation and create a personalized plan for you to set you on the right track for success. And then you also want to take control. So empower yourself with financial knowledge to make informed decisions about your future. Here's my contact information. So again, my name is Wes Paterson. I'm a certified management consultant. My email is wes@pattersonconsulting.ca. Patterson with one T. It's the Scottish Patterson. So Wes at Paterson consulting.ca. Thank you for taking time for this webinar, and I look forward to seeing you on the next one.